Imagine putting your hard-earned money into the market, only to watch it disappear during a downturn. Most people think market crashes are to blame, but the real culprit is often emotional investing without a clear plan. When excitement is high, many rush to buy. When fear strikes, they sell in panic. This cycle leads to losses and missed opportunities. In this video, we'll explore how smart investors avoid these traps by creating a balanced approach that blends growth, stability, and opportunity. By the end, you'll understand how to protect your investments and build wealth with confidence, no matter what the market does next. Start with a common scenario. An investor hears about a hot stock or cryptocurrency. Excitement builds and they buy in at the peak. But when prices drop, fear takes over and they sell at a loss. This emotional roller coaster is the downfall of many investors. Without a plan, it's easy to get swept up in the crowd, making decisions based on headlines and hype instead of logic. Smart investing means stepping back, creating a strategy, and sticking to it even when emotions run high. This is the foundation for long-term success. Most investors fall into three traps. First, they go all in on growth assets like stocks or crypto, hopping for quick gains. When markets crash, panic selling locks and losses. Second, some play it too safe, keeping everything in savings accounts. Over time, inflation erodes their purchasing power. Third, many chase the latest investment trend without understanding the risks involved. These mistakes can be costly, but they're avoidable with the right approach. Let's break down each mistake and see how balance can help you avoid them. Going all in on growth assets like stocks or cryptocurrencies can be tempting, especially when markets are booming. However, this approach exposes you to significant risk. When a downturn hits, the value of your investments can drop sharply, leading to panic and potentially selling at a loss. The lesson here is that chasing high returns without a safety net can backfire. Smart investors know that growth is important, but it shouldn't be your only focus. Let's look at why diversification matters. The other end of the spectrum, some investors avoid risk altogether by keeping all their money in savings accounts. While this feels safe, it comes with its own danger: inflation. Over time, the value of your money decreases and you lose purchasing power. Playing it too safe can mean missing out on the growth needed to build wealth. The key is to find a balance between safety and opportunity, so your money works for you without exposing you to unnecessary risk. Third common mistake is chasing hype. When a new investment trend emerges, it's easy to get caught up in the excitement and jump in without understanding the risks. This approach often leads to disappointment and losses. Smart investors take the time to research and understand what they're investing in. They know that real success comes from careful planning, not following the crowd. Let's move on to the first pillar of smart investing: growth. Growth assets are the engine of wealth building. These include broad market ETFs, global stock funds, and dividend growth stocks. Over the long term, these investments have historically delivered strong returns. The key is to invest consistently, regardless of market ups and downs. For example, someone who invests a fixed amount every month benefits from compound growth even during downturns. Growth assets reward patience and discipline, helping your wealth multiply over time. Compound growth is one of the most powerful forces in investing. When you reinvest your earnings, your money starts to earn money on itself. Over years and decades, that can turn small, regular investments into significant wealth. Even during market downturns, staying consistent with your contributions allows you to buy more shares at lower prices, setting you up for bigger gains when the market recovers. This is why long-term discipline is so important. Consider Sarah, who started investing $200 a month in a broad market ETF at age 25. She kept investing through market ups and downs, never stopping during downturns. By age 45, her portfolio had grown significantly, thanks to compound growth and her consistent contributions. Sarah's story shows that you don't need to time the market perfectly. Instead, steady investing and patience are the keys to building wealth over time. Most successful investors are those who stay the course, even when markets are volatile. Growth assets can be unpredictable in the short term, but over the long run, they tend to move upward. By focusing on patience, discipline, and consistency, you can ride out the bumps and benefit from the market's natural tendency to grow. Remember, wealth building is a marathon, not a sprint. While growth is essential, it's not the whole story. Stability assets play a crucial role in protecting your capital when markets fall. These include bonds, cash reserves, and defensive assets like gold. By adding stability to your portfolio, you reduce volatility and emotional stress, making it easier to stick with your investment plan during tough times. Let's see how stability works in practice. Bonds and cash reserves are the backbone of stability in any portfolio. Bonds provide steady income and tend to hold their value when stocks fall. Cash reserves give you liquidity, so you're never forced to sell investments at a loss during a downturn. By keeping a portion of your portfolio in these assets, you can weather market storms and take advantage of opportunities when they arise. Defensive assets like gold and certain types of bonds act as a shield during market crashes. When stocks tumble, these assets often hold their value or even rise. This helps cushion your portfolio and reduces the urge to panic sell. By including defensive assets, you create a safety net that allows you to stay invested and avoid costly mistakes during turbulent times. Imagine a market crash where stocks drop 30%. An investor with only stocks might panic and sell at a loss, but someone with a mix of stocks, bonds, and cash can use their stable assets to buy quality investments at a discount. Stability assets provide the flexibility and confidence to make smart moves when others are fearful. This is how stability helps you turn downturns into opportunities. Stability assets do more than protect your money, they also protect your peace of mind. When you know you have a safety net, it's easier to stay calm during market swings. This emotional stability helps you stick to your plan and avoid making rash decisions. In the long run, this can make a huge difference in your investment results. Now, let's explore the third pillar: opportunity. Opportunity investments are where you take calculated risks for higher potential returns. These might include real estate, online businesses, side hustles, or cryptocurrencies. The key is to only invest what you can afford to lose. Opportunity investments can boost your portfolio's performance, but they come with higher risk. Let's look at how to approach these opportunities wisely. Take Mark, who invested a small portion of his portfolio in real estate. He researched the market, chose a rental property, and managed it carefully. Over time, the property generated steady income and appreciated in value. Because Mark only risked what he could afford to lose, he wasn't stressed by short-term fluctuations. This example shows how opportunity investments can add value without putting your entire portfolio at risk. Lisa decided to start an online business as a side hustle. She invested a small amount of money and a lot of time learning the ropes. After a year, her business began generating extra income, which she reinvested into her portfolio. By taking a calculated risk, Lisa was able to boost her overall returns without jeopardizing her financial security. Cryptocurrencies are another popular opportunity investment. They offer high potential returns but come with significant volatility. If you choose to invest in crypto, it's crucial to limit your exposure and never risk money you can't afford to lose. Treat these investments as speculative and keep them as a small part of your overall portfolio. This way, you can benefit from upside without risking your financial foundation. Side hustles are a flexible way to pursue opportunity investments. Whether it's freelancing, consulting, or launching a small product, side hustles can generate extra income and open doors to new opportunities. The key is to start small, learn as you go, and only invest what you can afford to lose. Over time, a successful side hustle can make a meaningful difference in your financial journey. Secret to successful opportunity investing is balance. Don't put all your eggs in one basket. By keeping opportunity investments as a small part of your portfolio, you can enjoy the upside without risking your financial future. This approach lets you take advantage of new trends and innovations while keeping your core investments safe and stable. What does a balanced portfolio look like? For most people, a good starting point is 50% growth assets, 30% stability assets, and 20% opportunity investments. This mix allows you to build wealth, protect your capital, and still participate in high upside opportunities. The exact percentages can be adjusted based on your age, goals, and risk tolerance. Younger investors often have a longer time horizon and can afford to take more risk. This means they might allocate more to growth assets and less to stability. Older investors, on the other hand, may prioritize stability to protect their wealth as they approach retirement. The key is to adjust your portfolio as your life circumstances change. Everyone has a different comfort level with risk. Some people can handle big swings in their portfolio, while others prefer a smoother ride. Understanding your own risk tolerance is crucial for building a portfolio you can stick with. If you find yourself losing sleep over market moves, it might be time to shift toward more stability. Over time, your portfolio will drift from its target allocation as different assets grow at different rates. Rebalancing means adjusting your investments back to your original plan. This usually involves selling some winners and buying more of the laggards. Rebalancing once a year helps you stay on track and manage risk effectively. Dollar cost averaging is a simple but powerful strategy. By investing a fixed amount of money at regular intervals, you buy more shares when prices are low and fewer when prices are high. This smooths out the impact of market volatility and takes the guesswork out of timing the market. Over time, this approach can lead to better returns and less stress. One of the biggest threats to investment success is making decisions based on emotion. Fear and greed can lead to buying high and selling low. By sticking to your plan and focusing on long-term goals, you can avoid these costly mistakes. Remember, successful investing is about discipline, not intelligence. The most successful investors keep their eyes on the horizon. Markets will always have ups and downs, but over time they tend to rise. By focusing on your long-term goals and ignoring short-term noise, you give yourself the best chance of success. Patience and discipline are your greatest allies. You don't need to be a genius to succeed at investing. What matters most is discipline, sticking to your plan, investing regularly, and not letting emotions drive your decisions. Over time, this steady approach outperforms trying to outsmart the market. Anyone can develop the habits needed for investment success. Smart investing isn't about getting rich overnight, it's about building freedom, security, and peace of mind over time. By focusing on balance and following a disciplined plan, you can achieve your financial goals without unnecessary stress. Let's recap the key lessons from this guide. To recap, smart investing means avoiding emotional decisions, balancing growth, stability, and opportunity, and sticking to a long-term plan. Invest consistently, rebalance regularly, and never risk more than you can afford to lose. With patience and discipline, anyone can become a successful investor. Growth assets are investments designed to increase your wealth over time. Examples include stocks, ETFs, and funds that focus on companies expected to grow. These assets can be volatile in the short term but offer the highest potential returns over the long run. Growth is essential for building wealth and beating inflation. Stability assets are designed to protect your capital and reduce the impact of market swings. These include bonds, cash, and defensive assets like gold. Stability helps you stay invested during downturns and provides liquidity for new opportunities. It's the anchor that keeps your portfolio steady. Opportunity investments are higher risk, higher reward assets. These might include real estate, startups, side hustles, or cryptocurrencies. The key is to keep these as a small part of your portfolio and only invest what you can afford to lose. Opportunity adds excitement and upside potential to your investment mix. Balance is the art of mixing growth, stability, and opportunity in your portfolio. By diversifying across different asset types, you can reduce risk and increase your chances of long-term success. Balance is not a one-time decision, it's an ongoing process that adapts as your life and goals change. Rebalancing is the process of adjusting your portfolio back to your target allocation. As some assets grow faster than others, your portfolio can drift off course. By rebalancing once a year, you maintain your desired level of risk and keep your investment plan on track. Dollar cost averaging means investing a fixed amount at regular intervals, regardless of market conditions. This strategy helps you avoid trying to time the market and reduces the impact of volatility. Over time, it can lead to better returns and a smoother investment experience. Risk tolerance is your personal comfort level with investment ups and downs. Some people are comfortable with big swings while others prefer stability. Knowing your risk tolerance helps you build a portfolio you can stick with even during tough times. Emotional investing happens when decisions are driven by fear or greed instead of logic. This often leads to buying high and selling low. The best investors learn to manage their emotions and stick to their plan even when markets are volatile. Diversification means spreading your investments across different asset types, industries, and regions. This reduces the impact of any single investment's poor performance on your overall portfolio. Diversification is a key principle of risk management. Compound growth is when your investment earnings generate their own earnings. Over time, this creates exponential growth in your portfolio. The earlier you start and the more consistent you are, the greater the benefits of compounding. Inflation is the gradual increase in prices over time, which reduces the purchasing power of your money. Investing in growth assets helps you beat inflation and preserve your wealth. Ignoring inflation can erode your savings and limit your financial progress. Liquidity refers to how easily you can access your money when you need it. Cash and certain bonds are highly liquid, while real estate and some investments can take longer to sell. Maintaining liquidity in your portfolio ensures you're prepared for emergencies and opportunities. Asset allocation is the process of deciding how much of your portfolio to put into different asset types like stocks, bonds, and real estate. The right allocation depends on your goals, age, and risk tolerance. Asset allocation is the most important decision you'll make as an investor. Financial freedom means having enough resources to live the life you want without worrying about money. Smart investing is the path to achieving this freedom. By balancing growth, stability, and opportunity, you can create security and peace of mind for yourself and your loved ones.